Have you ever wondered how 16 of the smartest people on Wall Street nearly collapsed the global financial system and then walked away, leaving everyone else to hold the bomb? They weren't meme stock gamblers. They were Nobel Prize winners, Federal Reserve insiders, the kind of people textbooks worship and regulators trust. On paper, they built the perfect hedge fund. In reality, they created a financial weapon so leveraged that when it misfired, the Feds had to drag Wall Street's biggest players into a secret bailout meeting to stop the system from snapping. If I ever write a book about this, the title would be the same Warren Buffett joked about: Why Smart People Do Dumb Things. Because this isn't just a story about bad luck, it's about arrogance, secrecy, and a near meltdown the public was never meant to fully understand. Back in the mid 1990s, Wall Street formed its own NBA All-Star team, handing them billions to manage. This elite team included the future Nobel Prize winners, Myron Scholes and Robert Merton, and the brain trust of former Salomon Brothers. Together, they launched a hedge fund named Long-Term Capital Management, a name that sounded safe and boring but concealed a dangerous secret inside. Their trading strategy was like a black box, complex, proprietary, and not fully explained even to some of their investors. All the world saw was the magic numbers, insane returns. In just 4 years, LTCM transformed a little over $1 billion into more than $3.6 billion. They were printing money during years when the stock market itself was down. People didn't understand how, but it didn't matter. They only cared about performance until year 5. Year 5 didn't just bend, it snapped. LTCM's losses mounted so far and wild that the Federal Reserve quietly started running worst-case scenarios. Here's what they found. LTCM had burned through most of its $5 billion in capital. What was left? About $2.3 billion, and was stretched extremely thin beneath a mountain of borrowed money. The leverage ratio? About 55-1. That means for every $1 billion LTCM owned, it borrowed $55 more to place bets in the market. If LTCM defaulted, more than $100 billion in loan to over 50 major financial institutions will start unraveling. This wasn't just some isolated hedge fund failure. This was a live grenade wired into the global financial grid, and almost no one outside the inner circle realized just how close to disaster they were. LTCM kicked off in 1994 with a client list full of the world's wealthiest people and large institutions, even foreign governments. They handed over their money without truly knowing what was happening. The fund strategy was complex, the models were a trade secret, and the partners had the reputation of geniuses. In finance, that's a very seductive combination. The first May, LTCM posted a 7% profit. By the end of the year, 28%. All while the broader market was down. In 1995, the stock market bounced back 34%. LTCM shrugged and posted 59%. Year 3, 57%. Year 4, 25%. Those weren't just good numbers, they were legendary. In October 1997, two of LTCM's partners, Merton and Scholes, won the Nobel Prize for their groundbreaking work on the Black-Scholes model, which helped Wall Street price options and derivatives. The cruel irony? It wasn't the lack of understanding of derivatives that sank LTCM, but the catastrophic mispricing of risk related to those derivatives. After 1997, the warnings came fast. A 6.7% loss in May, another 10% in June, and then on August 21, 1998, LTCM lost $500 million in a single day. By the end of that month, almost all of their $5 billion capital was effectively gone. When the president of the New York Fed was shown LTCM's financial picture, he saw a nightmare. $2.3 billion of client money left, leveraged 55-1, on the edge of default on more than $100 billion in obligations. This wasn't just money lost, it was a systemic risk, a threat to the entire financial ecosystem. The decision was made. LTCM needed a bailout, but the money will come not from the government, but from a secret consortium of 14 major banks and financial firms deeply exposed to LTCM's trades. Together, they pulled $3.6 billion to save LTCM, quietly away from public eyes. In exchange, they took 90% ownership in LTCM, while the partners kept 10%, now worth less than their original investment after losses. Though LTCM was saved from a chaotic collapse, the damage was real. The partners lost close to $1.9 billion of their own money. The event triggered a global sell-off and sent shockwaves through the markets worldwide. And it revealed the danger in blind trust, placed in opaque models and secretive genius trading, no matter how brilliant. Flash forward to 2021. Bill Huang's Archegos capital management replicated many mistakes of LTCM, using secretive strategies and massive leverage. Archegos controlled massive stakes in companies, manipulating stock prices quietly. When their bets unraveled, banks suffered losses exceeding $10 billion. Huang and Archegos executives now face criminal charges for securities fraud. The collapse exposed dangerous gaps in regulation that showed the same story to nearly repeat itself decades later. LTCM and Archegos are cautionary tales, brilliant minds, complex strategies, hidden risks that bring down entire financial systems. Wealthy insiders benefiting while the public face all the fallout. These aren't just financial stories, they are human stories of greed, risk, failure, and survival. Will you be among the crowd brushing off a warning, or the few who see beneath the surface and prepare? Because in finance, the smartest often make the dumbest mistakes, and the rest pay the price.